Markets opened with a subtle shift in emotional gravity. Traders were not celebrating, they were recalibrating. The prospect of oil flows stabilizing did not erase geopolitical anxiety, but it introduced ambiguity. And ambiguity, paradoxically, can reduce fear. Risk assets moved higher not because the outlook improved dramatically, but because the worst-case scenario lost immediacy. Positioning that had leaned defensively began to unwind. Some investors stepped back incautiously, treating the rally less as opportunity and more as insurance against being left behind. The mood felt transitional, neither panic nor confidence. Just movement. Energy prices functioned less as an economic variable and more as a psychological thermostat. As downside pressure emerged, volatility expectations softened. Investors did not assume stability would last. They simply adjusted the probability of escalation. The symbolic threshold of 100 lingered in conversations not as a forecast, but as a line separating discomfort from disruption. Commodity-linked hedges were trimmed, while equity exposure was rebuilt selectively. The tone was pragmatic. Markets were not pricing peace. They were pricing time, and time, in periods of tension, becomes the most valuable asset. As geopolitical noise dominated headlines, technology reasserted itself as narrative shelter. Investors gravitated toward long-duration themes not necessarily because earnings visibility improved, but because future-oriented stories provided psychological distance from present risks. The AI cycle regained symbolic strength. Capital flows suggested a desire to anchor portfolios in secular growth rather than cyclical uncertainty. Even modest price advances carried outsized signaling power. They implied that risk appetite had not disappeared, only gone into temporary hiding. When the opportunity arose, it resurfaced quickly. Reports of workforce reductions were interpreted less as weakness and more as signals of capital discipline. Investors increasingly reward management teams that preempt uncertainty rather than react to it. Efficiency narratives resonated because they aligned with a broader macro instinct: conserve flexibility. Markets showed willingness to tolerate social discomfort if it translated into margin resilience. This dynamic revealed a subtle hierarchy of priorities: stability of cash flows above stability of sentiment. Risk assets can rally even while confidence in the real economy feels uneven. Attention gradually shifted toward central bank intentions. Investors were not demanding clarity, they were testing tolerance. The expectation of one eventual easing move functioned more as psychological reassurance than policy certainty. Markets sensed that energy shocks could complicate the balance between inflation vigilance and growth sensitivity. Yet few participants anticipated dramatic revisions. Positioning suggested a belief that policymakers would prefer continuity over surprise. In uncertain environments, predictability itself becomes a form of stimulus. By the close, the rally appeared intact but not secure. The advance resembled a tactical repositioning rather than a structural shift in conviction. Investors seemed aware that sentiment can reverse faster than fundamentals evolve. Gains felt conditional, dependent on the absence of negative surprises rather than the presence of positive catalysts. This distinction matters. Markets can rise while tension persists, but such rises tend to carry an undertone of vigilance. The session ended not with euphoria, but with a quiet agreement: risk is acceptable, for now.